at a 50-50 portfolio will give you somewhere in between. But lo and behold, what we find is it's 34%, and it's a significantly higher number. And this is what we at Axis call as the ninth wonder. I know, I'm sure all of you are aware of the 7 wonders of the world. And then there is the 8th wonder, which Einstein called out, which is compounding. And we at Axis have coined our term the 9th wonder, which is rebalance. So what happens in asset allocation, it's not just you allocate once and forget about it. As you keep on rebalancing your portfolio at set intervals, actually you can end up making higher return than the highest performing asset class at much lower risk. You have a reduced loss, reduced drawdowns, and lo and behold, you have, so it's a best of both worlds, lower risk, higher returns, and that's why asset allocation is so important. The third thing which I want to talk about, and I think that's where responsible investing comes in, is the fact that when it comes to equities, there is a significant role which sentiment plays. Now, sentiment, as we all know, is something which is true for every human being. It's a psychological thing. Even the best of fund managers are not safe from it. We sometimes act in haste. We look at the short run. We look at the newspaper headlines, and then we react. And most of the time, when it comes to investing, this reaction really creates havoc in our portfolios. So this is a slide which represents some of the tests or research which we at Axis have done. And you look at, and this can be done for any period, 10, 15, 20 years. And what you see on the left is equity funds at 3 bars there within equities. So as equity fund managers, last 20, 25 years, the mutual fund industry on an average fund has given about 18% returns. So has created sufficient alpha, which is outperformance. And about an 18.7 compounded return has been generated. And this is all the funds in the industry. And it has been weighted for the asset size as well. But when we look at investor returns, how much has an individual investor on an average made over the last 20 years? That return is only 13.2%. It certainly improves if the investors have invested through an SIP. But assume he's invested as a one-time or a investment, his return is only 13%. That's a significant gap. 13% versus 18.7%, 5.5% compounded for 10, 20, and you can do it for 10 years, 20 years, 30 years, whatever. A very, very significant gap. So now why does this happen? Now, this is happening because of timing. Investors probably get in at the wrong time, or they get out because sentiment is overruling. You get very afraid, or when the markets are really doing well, you just get in. And I think that creates this havoc. 5% compounded over 20 years. I think everyone can do the math. Significant loss of value. Now, the interesting thing is this is data for India, but there are enough studies available from the global markets. And even in the US, the gap between fund returns and what the investor actually earns is about 4.5% in equities. And a very interesting thing, while in India, in the fixed income space, investor returns are close to fund returns, but there is a significant gap, upwards of 3% between investor returns and fund returns, which means timing, which is often because of investors not sticking to a disciplined investment philosophy and strategy, getting swayed by short-term market trends, investing at the wrong time, or just not staying enough in the funds. It's easy to assume that if the entire fund industry was one particular fund, if investors had stuck to it for a long period of time, their returns will get very close to the 18.7%. The other thing which also it does is that as we increase the time frame of our investment, the risk goes down. A lot more probability for people to lose money over a 1 year or a 2 year period in equities. However, as tenor becomes 5 years and 10 years and beyond, your chances of losing money become next to zero. And obviously, long term, you can really gain healthily from the overall market. So, while there are many things we can talk about in terms of how to be a good investor, I think what I've tried to talk about are three things which are really important from an investor who's beginning to invest. One, obviously, you have to get into equity, but the equity market is not obliged to give you returns. As we have seen, there are lots of failures. So just stick to quality, and I think you will do really well. Even if you stick to quality, there is significant volatility. The best of companies can lose money over a short period of time. And hence, asset allocation, which we talk about, is the ninth wonder of the world. I think stick to that. If you can do that over long periods of time, you will get the advantage of rebalancing. And that, as I said, does wonders. And the third thing is stay the course. Fund managers across the industry, not just Axis, I think across the industry, have done a great job on the long term. If you just stick to being with them over the long run, I think you will do really very well. If you do just these three things well, I think you will do really better than maybe 95 or 98% of all investors who invest in equity markets. So lastly, make this out as a plan, because we all know if you do not plan, then we are planning to fail, or you're setting yourself up to failure. It's reasonably easy, or rather I should say simple, to create wealth using the opportunities which the equity market provides. But yes, it still needs to be planned out. It's not available on a platter. Volatility is the cost we pay to be in the markets. So we do need strategies to control or see us through this volatility. So high quality asset allocation and stay in the long run, and you'll be able to harness the opportunities of the equity market. And that brings me to the last point. And you do this, what we call is you become a responsible investor. Our approach at Axis has always been first to become a responsible fund manager. So we do all the stuff in terms of getting the right quality, risk management, etc. Do the right thing for the investor. But you have to, as investors, help us to create wealth. And these are the three things I would urge you to do. So if we can mix these two, responsible investing at the fund side and you being a responsible investor, I think there is a phenomenal growth and wealth creation opportunity available to us for the future. So I will stop here, and if there are any questions, happy to take that. Ankit?
Yeah. Hi, Chandresh. Thanks a lot. Thanks a lot for the presentation. That at least sets the right context to people as to why asset allocation is important. And there are quite a few questions that came during the presentation, so I'll just pick up a few of them, Chandresh. While you can probably stop the screen.
Yeah.
So the first question is coming from Gaurav. He's asking, what should be the min and maximum amount of time investment that we should make in mutual funds?
Sorry, in equities?
In mutual funds in general.
In mutual funds. So it's basically the underlying asset class. So if I presume the question is on equity. So equities, I think 3 to 5 years is a reasonably good time as a minimum. But as I just presented, the longer you stay, the better it is. Now the question is in a particular fund. So you will certainly be in the asset class. Now the next question will come in a particular fund. How much, and does it mean that requires very fund? It's about a different strategy, a large to a mid, or a diversified to a more tightly run fund, or a focused fund, or something like that, or a sector fund, etc. And since that requires timing issues, and nobody's been a good timer, I would say take a 3-5 year call on a good fund whose strategy is to invest in sustainable businesses. So you are not forced over 1, 2, 3 years to change the fund house. And every 3 to 5 years, just check. Sometimes their fund manager changes, etc. And that's another topic on how to choose fund houses and all that. I'm not getting into that. But if your basic thesis and the style of investing which you thought the fund manager was going to be using continues, then continue with the fund. The idea is not to say, hey, I'm investing for 3 years or 5 years and then get out. The idea is if there's something which is really running well for you, the manager is really doing what he's saying, generating significant alpha, low risk, reasonably high alpha generation, and just stick to it. But yes, it is important that you continuously keep reviewing that the basic tenets or the assumptions you made while choosing that fund remain true.
So another question that is coming from Shubham is that does rebalancing mean redeeming from one fund to another on a yearly basis? What does it exactly mean?
So there are a number of ways you can do rebalancing. Some of the rebalancing can be done in funds itself. There are fund of fund structures. There are individual funds. We talked about a dynamic asset allocation funds, etc., where it can happen on its own. And if it is not happening and you're choosing different funds, then yes, at the end of the year, maybe a small change. It's never going to be that you sell everything and buy everything afresh. What is the rebalancing? It means is that maybe you were started with 50-50 allocation and one asset class does much better. So maybe one asset class becomes, instead of 50, it becomes, let's say, 60 in terms of value, and the other becomes from 50 to, let's say, 55. So now you are total 115. So to rebalance is just selling the 60 down to 57.5 and the 55 going to 57.5. So yeah, it may require some small adjustment to the portfolio. And by the way, I think I do, while I did emphatically say it's the ninth wonder of the world, it truly is. There have been studies which have been done for people planning for retirement. The best strategy has been 50-50 portfolios in many 9 of 10 developed markets in the world over 25, because for retirement means you're talking about a 25-30 year time horizon. This has worked out to be the best, most appropriate style of investing. So yes, and it doesn't matter whether you rebalance 6 months, 1 year, or even 2 years. That's the other interesting part of the study, that if you feel that 1 year is too frequent, do it every 2 years, doesn't matter.
Okay. Next question that is coming from Bharat. I'll try to understand the question. So basically it says that how would you rebalance your portfolio, because say between mutual funds, there's a lot of overlap. So if there is 55% portfolio overlap, what's the point of rebalancing? So I guess he's trying to ask that ultimately rebalancing has to be between asset classes is what I presume. And he is understanding that it is between similar kind of
funds. No, obviously it has to be across the asset classes. By the way, the numbers and all which most people use are index returns, and generally when you look at your own portfolio, it might be a little different. Many times it will be outperforming. Maybe every fund with its strategy will have some periods of underperformance as well, so that's fine as compared to the index. So you have to look at not the index performance, you have to look at your fund performance and then do the rebalance.
Okay. Another question is coming on the chart that you showed, Chandresh, where you showed the fund return as 18.7%, whereas the investor returns much lower and the SIP returns somewhere in between. So the question that is coming is that in that chart, basically the fund return, so if a person would have been doing SIP since the inception of the fund, then would his return be same as the fund return?
So actually, very, very great question. The point is that index has risen so much. So generally you would expect if there is a lot of volatility, SIP return should be higher. But this is actual data, whatever the money we have seen over the last many, many years. So actual return in a market which has been on the tier 17% average long term does lead to a significantly lower return. But the point is right. I think most people are not going to put lump sum. People are earning over the next 20, 30 years. So the way to do it is to do the SIP way. Many times in many time frames, you'll actually find SIP returns to be better than fund returns as well, if there's been a lot of volatility and the market has not gone really one way. you can understand. If you look at a simple 12-month period and market goes up to 2% every month, and you do a SIP for 12 months, you're obviously going to be underperforming.
Obviously, lesser returns than what fund returns. Last couple of questions. So Parth is asking, if I do goal-oriented investing, still do I need to do rebalancing?
I would think yes, unless it's a small 3-year, 5-year one. If you're doing long-term, I would still believe that, because most goal-oriented thinking also is when the first plan is made, there is an asset come closer to retirement. If your asset allocation was 60 equity, 40 debt, most people will say maybe review at frequent intervals or at reasonable intervals and do what is necessary. Rebalancing in a time-bound manner is an algo you can use if you don't want to go through that entire long-drawn review process. That's a very easy way to do it.
Sure. Chandresh, last two questions, because I think this you can very aptly answer. A very nice question coming from Dhawal, that everybody keeps advising to keep investing. Nobody ever advises to sell. So when do we actually sell, and how do you make money?
Why do you have to sell? I mean, you sell and do what? You'll again invest back in the same, maybe a different fund or a different company if you are a direct investor. Mm-hmm. At the end of the day, you have to decide what is the use for your money. Are you? That's a very interesting survey which I came across, and it's a global survey done in developed markets. You ask people why are they investing. So yes, goal-based, etc. is fine. But in many of the investors are essentially saying they're investing to make more money. So if you have money and that's surplus, even when you retire, because these days longevity is, by the time many of the 25, 30, 35 years old today, year-olds retire, their life expectancy could be 90, 100. And fixed income is not going to be sufficient probably. So you have to continue investing. There is no reason, unless you want to consume, that you should just go out and sell. But yes, as a fund house, our objective or how we use the selling discipline is when our objective from that company is met, which means the next 5 years, it doesn't look like giving our target returns, or the story goes wrong. I think there is a risk. Sometimes companies start off well, but then over a period of time, the growth in the industry falls off, or there is new competition, some disruption, and then we think the next 5 years, holding this is just not worth enough. Then you get off. Or the third way, you hold something, but you find something much better. So you sell it and get into something else. The idea is never to turn into cash.
Got it. And the last question, which every millennial has to some extent today, is crypto also a part of the asset allocation? What are your views on it?
That's a great one. I'm trying to figure out myself. At the heart of it, I think it was as a concept. If it could really be used as store of value or even for transaction. So money has various functions, as a store of value and for trade and transactions. And my worry is that the significant volatility there is killing both these functions. So I don't know where it ends. But I think what I'm hearing now is the central banks are not very comfortable with this. And China has already started its own digital currency. US has just started talking about it. So I am actually very, very skeptical now on the future of cryptocurrency. I hope I'm wrong, because there is too much money sitting in there, trillions of dollars. If you can just imagine. So I do hope that there is no major volatility there, because it's now become such a big asset class. If there's a volatility there, it will spill over to other asset classes. But I think unless we get some kind of a rational movement in the asset class, it will not remain functional. And in some senses, if it's not going to be functional, reminds me of the tulips crisis. I don't know how many of you will know about it, but tulip bulbs in Netherlands in 1500 or 1600s, everybody just wanted to buy. And we all know it just dies over a period of time. And people are willing to pay a lot of money for it. So I'm not saying crypto is essentially that, but I am not a big fan of crypto. I used to be. Some time back, I thought it held potential. But today, the fact that there is this worry about paper currency, and so crypto was becoming an alternative to gold as well. But I think the what the central banks will certainly hate to lose control over money. And that, I think, is going to create problems sometime in the future. China has already talked about it. And I think central banks will step in. So if you want to dabble in a very small quantity. It still has, I think, good rationale to eventually emerge as something as an alternate to money. But my hopes have been dashed by the intrinsic volatility and the response by the central banks.
Sure. Thanks a lot, Sanjay.
That's the best I could do.
No, I think that's a great answer. It gives people perspective as to you have seen this over such a long time. Probably at least we knew something. I'm sure a lot of people are Googling about the tulip story for sure. So at least we get to know things which are new, right? So thanks a lot, Chandresh. Thanks a lot for your time. This was mighty helpful.
Thanks for having me here. These are very passionate about these topics. While we as a fund house can do whatever we can in terms of buying good businesses, etc., I think we need partnership from our investors. They behave or act responsibly. I think we can really improve. And sometimes feels bad that no, you are able to do well as a fund manager, you're doing well, but the investors are not able to take advantage of whatever we can deliver. So thank you very much. Thanks for having me, and all the best with your sessions.
Thanks a lot, Chandresh. Thank you. Bye-bye.
Thank you. Bye-bye and take care.
Now that we know, guys, what is the importance of asset allocation, let us check out what are the wide variety of asset classes available and understand that in a bit of more depth. For that, let's welcome our next speaker for the session, which is Mr. K.R. Hariharan. Welcome, Hari. Hari has over 19 years of experience and currently leads the learning and development segment for Axis Mutual Fund. Great, Hari. So due to lack of time, I would just give it to you and you can straight away go into your presentation and we'll have a few questions at a later point of time. Thank you.
Hope it's visible.
Yes, it is.
Okay. Great. Thanks. Good evening, all. Namaste, namaskar. Welcome all of you to this session. Basically, I will be talking about, as Ankit said, what are the various options, predominantly taking myself from the mutual fund perspective. Generally, when I do investor sessions, I normally start with the question that, why have you invested and where have you invested? I get a lot of responses, but typically when we talk of this, essentially what I want to talk about is what is the kind of landscape that's available in front of us as far as investments are concerned. And if I were to look at it, a very recent RBI report suggests that this is how the household investments look like in India. The household assets, the way they are distributed in India is like this. Almost 48% of the household assets are into real estate, which is into property. We have about 17% which is into gold, we have 16% into fixed deposits, 11% into insurance, pension, PF, provident fund, etc. Only about 4% in equities, which is surprising. And even more surprising is, despite so much of campaigns that have happened on mutual funds, the mutual fund SAHI campaigns, we still are at about 2% as far as mutual fund penetration. This is the landscape that we have, but interestingly, as I said, real estate sort of hogs the limelight. We have seen some kind of shift towards financial assets, but all said and done, we still have a lot of physical assets people tend to hold in India. Now, if I were to sort of categorize all of these into asset classes, okay, this is the way they would look. So broadly, we have 4 asset classes that typically investors can look at. One is obviously equity, we have debt, we have gold, and we have property. All of you would agree that each of these asset classes behave in different ways. They have very different characteristics and features. So let's quickly look at some of these features and characteristics. The first is equity, and all of us always say that equity is for the long term. Yes, it is for the long term. And when I talk about equity, it is both equity in the form of direct investment in shares. It is also in terms of mutual funds. Okay. The important point with regards to equity is that it is highly liquid, which means that I want to convert it into cash, मुझे बेच के निकलना, I can easily come out of it. The main reason why people tend to invest in equity is obviously the capital appreciation or the growth, and that's very, very important. Obviously, when we invest in equity, you are basically investing into businesses. So there is some amount of risk, but the risk generally gets commensurated with potentially high returns. And that's one of the biggest advantage that equity and equity mutual funds offer. When we talk of debt as an asset class, typically this is for the short term to medium term, and they are moderately liquid. The reason I'm saying moderately liquid is that in the debt category, I've also included your fixed deposits, your bonds, debentures, etc. And some of these corporate bonds or debentures are slightly illiquid in the sense that if I want to come out of these investments, there are challenges because the volumes are generally low, and there could be days when when there is no transaction in that particular category.
Sorry to again disturb you. Are you moving? The slides are not moving, so please.
I'm moving the slides. Slides are not moving.
But you are not presenting right now. It's you have not shared your screen.
It's showing me as I was screen sharing. Let's check. The screen did not move at all?
No.
Was this screen visible? Was this slide visible?
So Hari, once Hari, can you try sharing your screen?
It is. I'm doing screen sharing. Not visible. So let me just stop. Then again restart. Is visible?
Yeah, now we can see. So if you can probably follow,
Okay.
but probably 2-3 minutes again.
Okay, no issue.
So that people are understanding.
Okay, no issue. So essentially, what I was
And we are seeing the investment landscape slide here. Correct? Like
correct. So this was the first slide that I was referring to, and I was referring to the fact that RBI, the report on the household assets is what is being represented in this particular slide. So almost 48% of the household assets is into real estate, 17% into gold, 16% into fixed deposits, 11% into insurance, PF, etc. A very small percentage into equity shares, and even half of that into mutual funds, despite so much of campaign around mutual fund over the last so many years. If I were to categorize all of these into 4 asset classes broadly, if I were to categorize them, this is how the asset classes would look like. I have gone to the next slide. I hope it is visible. I am just confirming.
yeah, it is.
Okay, thank you. So essentially, if I were to categorize all those investments, I could categorize them into 4 buckets or assets. So we have equity, we have debt, we have gold and property. And I was saying that all of these asset classes have their own characteristics and features and behaviors, which is important for us to understand as an investor. So equity, I was referring, is obviously everybody knows that it is long-term in nature, that it is highly liquid, and generally people invest from the perspective of generating long-term capital appreciation or growth. So there is some element of risk because ultimately I'm going to invest in businesses, but the potential returns are also commensurate to the kind of risk that I take. 2 is debt, and when I talk of debt, I've included the entire basket of debt, and therefore I have looked at it from the perspective of short and medium term. And I've also put the word moderately liquid because there are certain corporate bonds and debentures which are not very liquid, so utne aasani se main bech ke nahi nikal sakta because there are days when those don't get transacted at all. So that is why I've used the word moderately liquid. But there are, of course, there are schemes, within mutual funds, which I will discuss subsequently, which are absolutely liquid. The reason why people come into debt is very simple. I want to generate regular income, unlike the capital gains that I want to try and so that is medium risk, and there is moderate kind of returns that you expect from debt. Coming to gold as an asset class, I said 17%, and as this happens to be one of the most traditional favorites of Indians, which is buying gold in some or the other form. Gold happens to be a cyclical asset in the sense that there could be years where gold will do extraordinarily well. And when I talk of cyclical, essentially there are events, which actually trigger the demand for gold. So, for example, if I were to relate to what happened last year in March 2020, all of us know that because of COVID, the market came crashing down by 37%, and people were very, very pessimistic, and there was a lot of uncertainty around what is going to happen. And this is the time when typically you will find gold tries to get a lot of mind share, and people start going towards gold because it's considered to be a safe haven. So these are the times when gold typically will perform very great, phenomenal returns. And in a matter of few months, if you recollect last year, gold appreciated and went to almost 60, 62, 65,000 rupees. But at the same time, gold is also an asset which is highly liquid. People can easily get rid of it, convert it into cash. There is some amount of capital appreciation that has happened. So I will discuss some of the points as we go along. There is medium amount of risk and return. Property is an asset class, even though it still has a fairly great amount of share in the household assets. Typically, it is illiquid, and I cannot sell one room. If I have to sell the property, I have to sell the entire property. So I cannot sort of segregate and say that I want to only shed away with my one balcony and one room or living room. That's not possible. So illiquid asset. Generally, people invest from the perspective of regular income because I can get rental income and there's a possible capital appreciation. Please remember, when I use the word property as an investment, it is a property which is over and above your self-occupied property. जिस घर पे मैं रहता हूँ वो मेरा investment नहीं है, because that's being occupied by me. So anything beyond a self-occupied is what we normally call as a property or the real estate asset. There is a great amount of risk involved. I'm sure many of you would be tracking what has happened, especially with the RERA Act that has come. There are challenges that real estate industry is facing. I will not get into details of it, but there are clearly challenges. The risk has become higher now, and returns have been very, very low, in terms of what has happened in the last few years. Okay, so this is broadly the four asset class. Now let's look at how have these asset classes performed over the last 20 years. I have excluded property because the variance in property can be significant depending on the geography or the. So if I were to look at the 20-year returns of equity, debt, and gold, these are calendar year returns for each of these years, which is January to December. You will find that the returns are quite scattered, irrespective of the asset class, that's equity, debt, or gold. But interestingly, you will find that, especially when you look at equity data points, 2001, 8, 11, there has been a significant fall in the performance in terms of corrections that we have seen, especially 2008, which was the global financial crisis. You had more than 50% of your investments gone. So 100 rupees would have become 49 rupees in the year 2008. Now, that's a very dangerous proposition. Similar kind of downside we have seen in 2011. The markets corrected by sort of 24%. Now, what is interesting in the entire table is, if you look at it closely, there is no single asset which is number one for all the 20 years. Okay. So if you look at it, equity out of 20 years, equity has been number one for 10 years. And all of us know that, intuitively, equities will be one of the best performing asset classes. But every year, not possible. Debt has been number one for about, gold has been number one for about 5 years. Debt has been number one for about 3 years. And gold and debt have jointly been number one for 2 years. So essentially, this table is a very interesting table because it tells us as investors that if I invest in one particular asset class, the returns can be quite fluctuating, especially when it comes to equity. Okay, the returns can be staggering at one point in time. At some point in time, it can be pathetically low. Therefore, it brings to a very, very interesting topic and discussion. Which is that if you look at the 20-year track record, equity has stood out in terms of the average performance. And that is what you expect from equity, right? So it's the number one asset over the last 20 years. Debt is more stable. You got 10% returns. Gold has given about 13.5%. Now, what is also interesting is, if you relate it to the previous number that I told in the table, equity also happens to be very, very volatile. It's very fluctuating. Look at the fluctuation which is measured in terms of the standard deviation. Equity has got a standard deviation which is the highest, which is almost 32%. Debt is more stable. Okay, it's more consistent. It has got deviation, but the deviations are fairly low. It's only about 8%. Gold is more volatile as compared to debt, far less volatile as compared to equity. Now, if I were to correlate this to equity parlance, so to a cricket parlance, it is like a Sehwag. Sehwag can hit a six of the very first ball. Now, these are very important learnings that we need to carry in our investments. Okay, that equity, yes, is one of the best asset classes to invest from a long-term perspective. But if I have only equity in my portfolio, there are challenges. Okay, so what kind of asset classes should I look at is very, very important. And for that, let me quickly explain that a very interesting anecdote. Something from mythology. What you see on the screen is the photographs, is essentially the family photo of Lord Shiva. All of us, if you see Lord Shiva, he's got a moon on his head. Unke sar pe chand hai. And this moon is supposed to contain nectar or amrit or elixir of life. Despite the fact that he has got elixir, he has got amrit, Lord Shiva prefers to drink alahar, which is poison. Contrasting, right? Similarly, you look at his neck, he has got a snake around his neck. He has got his son, which is Ganesha, and Ganesha has got a vehicle, which is Mushak, mouse. All of you know that a snake can eat a mouse. So typically where there is a snake, you will not find a mouse. But in this family, you see, there is a snake, there is a mouse also, living together. Another interesting thing, he has got another son whose name is Kartikeya. So down south, we call him as Murga. Now he has got a vehicle, which is peacock. Now, I don't know how many of you know this. A peacock can actually eat a snake. So again, ideally, where you find peacocks, you will not find snakes. But in this family, you find a peacock also, you find a snake also living together. Okay, Lord Shiva has got a vehicle which is Nandi, which is bull, the male version of a cow. And a cow, generally, when we talk of cow, it's a guy hai. It's innocuous, which is very poor chap, So it is armless to a large extent. But look at Parvati. Parvati has got a lion or a tiger, ferocious, and it can eat the bull or the cow. So we have aggressive, non-aggressive, everything in the same family. So contrasting characteristic, contrasting behavior, but all of them are staying in the same family. And look at Lord Shiva. He's smiling in the photograph. He's very happy. Despite the differences in the family, he's having a very happy, peaceful family. The same thing we need to implement in investment. We have looked at equity, debt, gold. What are the features and characteristics? Now, what is important is this. All the asset classes I already showed in the table does not move or give returns every year. But there are some correlations which we consider and look at, which essentially tells how does one asset class behave in the presence of another asset class. That's interesting. Many of you would have seen Big Boss. Big Boss में आपने देखा होगा ना, there are people who are very pally with somebody. They're very friendly with somebody. उनके साथ बहुत अच्छा जमता है. But there are some set of people, with whom they cannot even look at their face. 36 का आंकड़ा बोलते हैं. So those kind of things exist even in investments. Certain asset classes tend to go together, which means they move in the same direction. Certain asset classes tend to move in opposite direction. And that's important. If I have all the assets which move in the same direction, what will happen? On one fine day, I will be on the moon because my portfolio is gone, rocketing upwards. I'll be very happy, man. But there could be days when markets are corrected and all the assets come down together. I will feel like committing suicide. So if I have all the assets which move in the same direction, then there's a problem. So just like the family which we saw in Shiva's family photograph, we need to have asset classes which can be moving in opposite directions. And that is what is referred to as the coefficient correlation. So if you look at it from the table, equity and debt has got a coefficient or a correlation coefficient of minus 0.5, which means they tend to move in opposite direction. This is important, especially when there are significant market corrections. When I talk of market correction, equity market corrections. Because when markets fall, you need to have something which can give you stability. Okay, and that is where debt will come into. Because market falls, debt will continue to give that returns. So some part of the portfolio will get positive returns and your portfolio looks more balanced. And there's a cushion to your portfolio. That's the entire objective of asset allocation. Okay, gold and equity has got very low correlation, only about 0.02, which means there's not much of correlation between both the asset classes. Now, if I have understood this as asset classes, equity is there, debt is there, gold is there, how do I participate in these asset classes? So one is that I can go and invest in equity markets, buy shares. I can do my own debt investments. I can also keep buying gold. But what I'm going to talk about is from the mutual fund perspective. Mutual fund gives me the flexibility to purchase all of these asset classes. So I can participate in equity, I can participate in debt, I can participate in gold, all through mutual. I will not get too much into what is a mutual fund. I'm sure everybody knows about it. All of you have been investing. So very broadly, it is nothing but there's a pool of investors. We collect money from the investors, give it to a fund manager who will then invest these money into different securities. Okay, it could be equity, it could be debt, or they could invest in a mix of both equity and debt. Okay, so this is how the mutual fund typically works. A basis where the fund manager invests, we have got different types of mutual funds. So we have equity funds. As the name suggests, will invest in equities. And when we talk of equities, basically the fund manager will invest in shares of the company. Okay. Then we have debt mutual funds in which the fund manager will invest in debt instruments. So he could invest in a corporate bond or a debenture, could invest in a government bond, etc. Then we have hybrid funds. So this is the combination of equity and debt. So this hybrid funds, oriented funds, which are also available. So if you look at it within each of these asset classes also, you will have different categories of mutual funds. So we will not get into all of these today. That's not part of our discussion today. Broadly, what I'm trying to say from this slide is that whether it's equity, whether it is debt, whether it is a mixture of equity and debt, or if it's gold. So I will come to where does gold come into this picture. All of these are available under the single investment, which is the mutual fund space. Let's quickly get into some of these. I will just refer to index funds and ETF because that's going to be one of the discussion points that I'm going to do. Index funds are essentially passive funds. What do I mean by passive fund is typically when we give money to the fund manager in a mutual fund, the fund manager does a lot of research. Okay, there's a lot of effort that goes into identifying businesses, identifying stocks, and then the portfolio is constructed. Index fund, in this the fund manager does not do too much of research. What does he do? He just goes and copies an index. I'm sure all of you know what is an index. So a very simple example of index is Sensex and Nifty 50. Okay, so in Sensex, there are 30 stocks. So if I'm a fund manager who is having an index fund, which is a Sensex-oriented index fund, what will I do? I will just copy and buy the same 30 stocks which are there in the Sensex, in the same proportion which is there in the Sensex. So if a Reliance Industry has got an 8% weightage in Sensex, out of 100 rupees that I invest, I will also allocate 8 rupees towards Reliance. So that is how an index fund is. So it's a very passive fund. The fund management charges are lower. Extension of the index fund is what we call as an ETF, which is an exchange traded fund. So I will get to more of ETFs in some of my subsequent slides. Okay. So ETF is an exchange traded fund which is traded on the stock exchange. So it's very similar to stocks. We will see in a couple of slides. Okay. Now let's see, if I want to participate in equity as an asset class, I have two choices. One is I can go and buy stocks directly, or I can take the mutual fund route and invest in an equity mutual. So what is the difference between both of them? A couple of important points that as investors we need to understand. One is the diversification. Now, if you see these stocks, or whether it's BSE and NSE put together, we have more than 5,000 companies which are listed on the stock exchange. Now, can I personally and individually invest in all these 5,000 stocks? Impossible. At best, I may invest in, say, 20 stocks, 30 stocks, or 50 stocks. So I have diversified, but the diversification is limited. In a mutual fund, what happens? The fund manager in general scheme, any of the diversified schemes, if you look at, will invest in close to 60, 80 stocks. So the range of diversification is much higher in the case of mutual fund. Management, I'm going to personally manage versus in a mutual fund is going to be professionally managed by the fund manager. Cost is low because when I invest in shares, there's a tendency for me to enter today, exit after a few months, again enter, again exit. So the transaction charges will increase because of the frequency that I do. In the case of mutual fund, we have a fixed annual maintenance charge, which we call as a fund management charge. Okay? Options, if you look at stocks, all said and done, whether I invest in 30 stocks, 50 stocks, 100 stocks, or all equities. But mutual fund gives me the option to invest across the different asset classes. Capital required is very high in shares, especially if I want to own some very good brands and businesses. The share price of each of these companies can be very high. So cumulatively, I will end up paying a higher cost. In a mutual fund, I can participate and buy the same shares indirectly, okay, through the mutual fund by entering into or starting a SIP with as low as 500 rupees every month. Even if I do a lump sum, I can start with as low as 5,000 rupees. Okay, so that's the flexibility that mutual fund offers. So I get the exposure to those businesses, but at a low cost, for the low capital. Similarly, in the case of bonds, as an individual, I can buy bonds and debentures of companies. Versus I can get into a debt mutual fund to participate in the debt asset. Again, diversification is limited. As an individual, I may invest in 5 different fixed deposits or maybe 3 or 5 different corporate bonds. But a mutual fund manager in a debt mutual fund typically will invest in about 80, 90 different securities. Okay, so again, the kind of diversification that you get is very, very high. The other advantage with the debt mutual fund is that when you compare it with a typical bonds or the debenture or the fixed deposit, FD though is very clear that I get only the interest income. In bonds and debentures also, the intention of the investor is to get the interest income, but I can also get some capital gain provided I have liquidity to come out of those investments. Okay? But in the case of debt mutual fund, the fund manager can generate both capital gains and he can also generate or get the accrual of the interest in. Taxation is another important point. In the case of debt mutual fund, short-term taxation is considered to be an investment where you exit before 3 years. Long-term is beyond 3 years. And one biggest advantage that debt mutual fund offers, especially compared to fixed deposits, is that if you hold it for more than 3 years, you get an indexation benefit. Okay. If you look at bonds and debentures, now the taxation is dependent on whether it's a listed bond, it's an unlisted bond. Okay, so it's not that simple as the case of a debt mutual fund. Let's come to ETF. This is the second topic that I want to talk about. As I said in my previous slide, ETF is the exchange traded fund. The word means that these are mutual funds which are traded on the stock exchange. So how does it look like? Essentially, it is nothing but designed in such a way that the fund manager will try to track the performance of the underlying index or the benchmark. So just like index funds, they will create the portfolio which is exactly the same as the underlying index. Advantage with ETF is I can buy units, okay, which are bite-sized units. So I essentially pay a fraction of the amount. So let me give a very simple example. If I want to buy the Nifty 50 stocks, so all the 50 stocks which are there in the Nifty, even if I were to buy one share of these companies, I will have to end up paying more than ₹1 lakh. But the same 50 stocks I can buy through a Nifty ETF, and I will have to pay only a fraction, maybe 1/100th of the Nifty value. So let's hypothetically assume that Nifty is 15,000 today. I can buy 1 unit of an ETF at 1/100th of 15,000. So I end up paying only 150 rupees, and I can buy 1 unit of the ETF, which is basically I'm buying the entire basket of 50 stocks at 150. That's the biggest advantage that ETF offers. Okay. Let's quickly compare it with the active mutual fund. The purpose is very different. In the case of active mutual fund, the objective is that the fund manager wants to beat the benchmark or generate returns better than the benchmark. In the case of ETF, the objective is to track the index or the benchmark. So it's a passive style. Active is more active. The trading frequency, if you look at it, the ETF, it is actively traded. So you can enter, exit at any point in time. Whereas in the case of mutual fund, typically you can do only once in a day. Okay, ETF is low in terms of the cost. Active mutual funds, of course, there's a capping in the active mutual fund also in terms of what is the kind of price that you pay in terms of cost, but it is more expensive as compared to ETF. The other advantage that ETF offers is there's no exit load. And I will come to this part of my discussion in my last slide, how this can easily be applied and used by investors. There's no exit load in the case of an ETF. ETF, as I said, is very similar in terms of some of the operational aspect to stocks, listed on a stock exchange, traded on all the business days. I can put a limit order in the case of an ETF, which is not possible in the case of a mutual. So whatever is the NAV declared is the price for me. Okay, but in the case of ETF, I can put a limit order, and as and when the limit order gets triggered, I can get those units at that price. And of course, in the case of ETF, you need to have a demat account. Right? Quickly, the comparison between ETF and stocks. What you buy in an ETF is the entire index, whereas in the case of stocks, you end up buying individual stocks. Cost of capital, as I explained in the comparison between mutual fund and stocks. In the case of stocks, the cost of capital is higher. In the case of ETF, as I gave the example of Nifty 50, I pay only 150 rupees to get 1 unit of the entire index. Okay, so I pay a fraction of the amount. I get more diversification because I buy the entire index as compared to buying individual stocks. Time and effort required is very low because I don't have to study too much as compared to when I invest into stocks, because I need to study what is happening to the business. So for example, if I buy a share of Colgate-Palmolive, I need to understand what is happening to Colgate-Palmolive in terms of the sales, in terms of the profits, and etc. So it is time consuming, and depending on the number of shares that you hold, and every quarter you need to look at what is happening to the business. All those things you don't have to do when you look at investing through any. Okay, so that's the time and effort is much lower. At the same time, get more diversification as compared to stocks. Now, coming to my last 2 slides, having understood what mutual fund is, different types of assets within mutual funds, how can I actually construct a mutual fund portfolio using both active funds and ETF? Okay. There are advantages with mutual fund, there are advantages with ETF. We have understood that. So how do I merge sort of both of them, and how do they complement each other? So let me explain this with a very simple example. All of us know that this is the pizza. Now, typically, most of us would have ordered a pizza in our life, So we could order a pizza, which could be a very simple plain pizza, margherita pizza. You could have a peppi paneer, etc., etc. Now, this is a very simple dish. If I am interested, I can also have some toppings on this. So I can have for the cheese buster. Okay, so I can have additional cheese. I can also have a topping in the form of crispy capsicum, maybe some black olives, jalapeno, etc. So what am I trying to do? I have a base, which is the pizza, okay, which is the base dish, and I can have toppings on that. Okay, same thing is what we can apply in the form of mutual fund and ETF. How does that work? Let's quickly look at it. So you can create a core portfolio, which is the main dish. And then we have something called as a satellite, which is around that. So it's like the topping on the pizza. So what can the core portfolio consist of? Typically, you can have active mutual funds as part of your core portfolio. And within active, we have discussed so many schemes. We have equity, debt, etc. But predominantly, I'm just restricting myself to the equity perspective. So we could have a large cap, mid cap, etc. Objective is very simple. I want to create wealth for the long. So that's my core portfolio. I can have a satellite portfolio like the topping, which is about 20-30%. Right? Now, what can I include in this toppings? I can have an ETF, which is an exchange traded fund. And within exchange traded fund, because I'm already diversifying in terms of taking large cap, mid cap, small cap, so that is already there as part of my core construct or core portfolio. In the satellite portfolio, I can look at taking some sectoral allocation. So maybe I want to invest in a pharma fund. So I can take a pharma ETF or a healthcare ETF. I can invest in a banking ETF. I want to invest in IT, so I can take a IT. So those kind of sectoral bets is what you can look at from a topping portfolio or the satellite portfolio, which you can take in the form of ETF. Similarly, I can also use ETF for tactical allocation. What do I mean by this? Now, what happens is, let's take a very simple example like what we have seen of COVID. Now, we have seen COVID last year, first wave. We are now seeing the second wave. If you recollect, last year again, when COVID first wave happened, pharma stocks started doing well. The healthcare sector started doing well. So these are tactical bets that I can take. That if I feel that because of COVID second wave and there's an impending COVID third wave that can also come in,